What if I told you the Dividend ETF everyone's been sleeping on just crushed SCHD by nearly 5% this year? I know that sounds impossible because for over a decade, SCHD has been the undisputed king of dividend ETFs, the safe choice that every financial advisor recommends. But something fundamental has shifted in the dividend landscape, and today we're settling the ultimate dividend debate once and for all. By the end of this video, you'll know exactly which ETF deserves your money in 2025, and trust me, the answer might shock you. For over a decade, SCHD sat comfortably on the dividend throne, and honestly, it deserved to be there. This wasn't some lucky streak or market fluke. From 2012 to 2022, SCHD consistently beat the S&P 500, delivering the kind of performance that made dividend investors feel like geniuses. With its solid 3.89% dividend yield and an impressive 11.30% dividend growth rate over the last 10 years, SCHD became the gold standard. It was the ETF you could recommend to your grandmother, your cautious neighbor, and even that friend who's terrified of anything riskier than a savings account. The Charles Schwab U.S. Dividend Equity ETF, with its 103 carefully selected holdings and rock-bottom 0.06% expense ratio, seemed unbeatable. Every quarter, they'd rebalance to keep no single holding above 4%, maintaining that perfect balance of safety and performance that made SCHD the darling of dividend investors everywhere. But something changed in 2023, and the cracks in SCHD's armor started to show. While dividend investors were sleeping soundly, confident in their choice, the world was transforming around them. Technology wasn't just disrupting traditional industries anymore. It was creating entirely new categories of dividend-paying companies. The old playbook of energy stocks and consumer staples was starting to look outdated, like trying to win a Formula One race with a reliable family sedan. Sure, it'll get you there, but will it get you there first? The tech revolution wasn't just leaving value stocks behind. It was creating a new class of dividend aristocrats that SCHD's 10-year dividend history requirement simply couldn't capture. While SCHD investors watched their returns stagnate compared to the broader market, a quiet challenger was building something remarkable, something that would challenge everything we thought we knew about dividend investing. Enter DGRO, the iShares Core Dividend Growth ETF, and this is where the story gets really interesting. While SCHD was playing defense with its 103 holdings, DGRO was playing chess with 416 carefully selected companies. But here's the genius part that most investors completely miss. DGRO doesn't just look at market cap weighting like most ETFs. Instead, it weights companies based on how much dividends they've actually paid over time. This means Microsoft and JP Chase can both be top holdings despite having completely different market caps, because they're both dividend powerhouses in their own right. The secret weapon that's been hiding in plain sight is DGRO's 5-year dividend requirement versus SCHD's 10-year requirement. This seemingly small difference opens the door to companies like Microsoft, Apple, and Broadcom, tech giants that have become serious dividend players, but haven't been around long enough for SCHD's more conservative criteria. The performance numbers tell a story that will make your jaw drop. Over the last 5 years, DGRO has delivered an average annual return of 13.08% compared to SCHD's 12.49%. Over 10 years, it's 11.47% versus 10.8%. But here's where it gets really interesting. In 2025, year-to-date, DGRO is up 2.31%, while SCHD is actually down 2.27%. That's nearly a 5% difference in just the first part of the year. While SCHD clings to traditional energy and consumer staples, DGRO has embraced the future with significant positions in technology and financials. This isn't just about picking winners and losers. It's about recognizing that the very definition of a dividend stock is evolving. Microsoft alone has transformed from a growth stock into a dividend powerhouse, and DGRO was positioned to capture that transformation while SCHD was stuck waiting for the 10-year threshold. Now let's break this down round by round, because this isn't just about picking a winner. It's about understanding what each ETF brings to the table. In round 1, income generation, SCHD takes a clear victory with its 3.89% yield crushing DGRO's 2.27% yield. If you're retired and need that quarterly income to pay your bills, SCHD delivers almost 70% more dividend income per dollar invested. Plus, SCHD's dividend growth rate of 11.30% over the last 10 years beats DGRO's 9.06%, meaning your income is growing faster with SCHD. But here's the plot twist about taxes that most investors never consider. DGRO's lower dividend yield actually means less taxable income in your taxable accounts. You're building wealth through appreciation rather than dividends, which means you control when you pay taxes by choosing when to sell. Round 2 is growth potential, and this is where DGRO starts to shine. The inclusion of tech giants like Microsoft, Apple, and Broadcom isn't just about diversification, it's about capturing the future of dividend investing. These companies aren't your grandfather's dividend stocks, but they're generating massive cash flows and returning billions to shareholders. Microsoft alone has become one of the most reliable dividend growers on the planet, and its inclusion in DGRO gives the ETF exposure to the AI revolution, cloud computing growth, and the digital transformation that's reshaping every industry. While SCHD's energy-heavy portfolio performed brilliantly in the commodity boom, DGRO's tech exposure positioned it perfectly for the AI and technology boom we're experiencing right now. Round 3 is diversification, and the numbers here are staggering. DGRO's 416 holdings versus SCHD's 103 holdings might seem like overkill. But consider this. SCHD's top 10 holdings make up 41% of the portfolio, while DGRO's top 10 only represent 26%. This means if one of SCHD's major holdings runs into trouble, it can seriously impact your returns. Remember when SCHD dropped Broadcom from their portfolio a few years ago, right before Broadcom went on a massive run? That kind of concentration risk is exactly what DGRO's broader diversification helps you avoid. The top 100 holdings in DGRO make up about 80% of the portfolio, giving you exposure to dividend growth across multiple sectors and industries. Round 4 is stability, and this is where SCHD's value-focused approach really shines. When markets get choppy and investors start running scared, value stocks tend to hold up better than growth stocks. SCHD's focus on established companies with long dividend histories means you're investing in businesses that have weathered multiple economic storms. Between 2012 and 2022, SCHD outperformed the S&P 500, and that wasn't luck. Value investing works over long periods, and companies like Coca-Cola, PepsiCo, and Home Depot have proven they can generate cash and pay dividends regardless of what's happening in the broader economy. When the next recession hits, and it will eventually, SCHD's defensive characteristics could be exactly what your portfolio needs. Round 5 is future-proofing, and this might be the most important round of all. The world is going digital. Artificial intelligence is transforming every industry, and the companies that will dominate the next decade might look very different from the ones that dominated the last decade. DGRO's methodology allows it to adapt to these changes much faster than SCHD. When a company like Tesla starts paying dividends, or when emerging fintech companies mature into dividend payers, DGRO's 5-year requirement means it can include these companies much sooner. The portfolio turnover is also lower with DGRO because when you have 416 holdings, replacing a few underperformers doesn't require the same dramatic reshuffling that SCHD's more concentrated approach demands. So which fighter fits your investment style? If you're part of Team SCHD, you're probably what I call an income warrior. You might be retired or approaching retirement, and you need that dividend income to pay your bills. You value simplicity and don't want to worry about 416 different holdings when 103 carefully selected ones will do just fine. You believe that value investing will eventually have its day again, and you're willing to accept lower returns in exchange for higher current income and the peace of mind that comes with investing in established, profitable companies. You're betting that energy, consumer staples, and traditional dividend aristocrats will bounce back, and honestly, history suggests you might be right. If you're part of Team DGRO, you're what I call a growth hunter. You're probably younger, with a longer investment timeline, and you're more interested in growing your wealth than generating current income. You understand that the investment world is changing, and you want your portfolio to change with it. You're comfortable with the complexity of a more diversified portfolio, and you appreciate the tax efficiency of building wealth through appreciation rather than dividends. You're betting on technology, innovation, and the continued digital transformation of the global economy. You see companies like Microsoft and Apple as the dividend aristocrats of tomorrow, not yesterday. But here's the thing. Maybe this isn't really about picking sides. Maybe the smartest approach is understanding that both ETFs serve different purposes in a well-constructed portfolio. A 70-30 split between DGRO and SCHD could give you the best of both worlds. The growth potential and future-proofing of DGRO combined with the income generation and stability of SCHD. Or maybe you allocate based on your age and risk tolerance, starting heavy in DGRO when you're young and gradually shifting toward SCHD as you approach retirement and need more income. Looking ahead to the rest of 2025, several trends could determine which ETF comes out on top. Interest rates are still a major factor. If rates continue to fall, both dividend ETFs should benefit, but DGRO's growth orientation might give it an edge. The artificial intelligence boom is far from over, and DGRO's tech exposure positions it well for continued AI-driven growth. On the flip side, if we see a rotation back to value stocks, or if energy prices spike again, SCHD could quickly regain its performance leadership. The key is understanding that markets are cyclical, and what's working today might not be what works tomorrow. The real truth about this dividend battle is that it's not really about picking the perfect ETF. It's about understanding how the investment landscape is evolving and positioning yourself accordingly. Both SCHD and DGRO are excellent ETFs that serve different purposes for different investors at different stages of their lives. The most important thing is that you're investing in dividend-focused ETFs at all, building wealth over time, and staying committed to your long-term financial goals. Your homework after watching this video is simple. Calculate your actual dividend needs, consider your time horizon and risk tolerance, and decide whether you're an income warrior or a growth hunter. Then make your choice and stick with it through the inevitable ups and downs that every investment experiences. Comment below and let me know. Are you Team SCHD or Team DGRO? And what's driving your decision? If this analysis helped you think differently about dividend investing, make sure to subscribe because the dividend wars are just beginning. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.